Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
Hey, Dean. Hope all is well with you. It seems like it's been a while since our last podcast. So what topic are we discussing today?
Hi, Len. Great to see you. Yes, our last podcast recording was actually April 3rd, but we all need some time off. But welcome back, and it is nice to be back. It's nice to be with you. So today I thought I'd talk a little bit about fair lending, but in the context of appraisal, discrimination, and bias. As you know, fair lending is a major hot topic and continues to be a major hot topic. And we've discussed many issues over the last few years and months in regards to fair lending. But one issue that just keeps resurfacing is the fair lending issues with appraisal bias.
Oh, yeah, I totally agree with that. It's a widespread topic in banking circles today. Excellent topic. I'm certain our audience will find your presentation interesting. Take the show on the road. Go ahead, Dean.
Yeah, well, I hope so. Yeah, for sure. So appraisal bias is, like you say, or like I'm saying, I guess, is an emerging issue, and it's under the microscope of the regulators. And most recently, the FFIEC issued a statement February 12th of this year on behalf of its member entities to communicate principles for examination of supervised institutions, residential appraisal and evaluation practices. Basically, two concepts or two channels: mitigate risks that may arise due to potential discrimination or bias in those practices, and two, promote credible valuations from, of course, independent appraisers.
Well, Dean, appraisal bias is one of those terms that I think everybody thinks they know what it means, but maybe they don't understand the technical aspect of it. So exactly what is appraisal bias?
Well, that's an excellent question, Len, and I think people's perception probably is pretty accurate as to what it could be, but let me jump in. Appraisal bias can occur in many different forms, so I think it's important to kind of break that down a little bit. So some examples of such harm are consumers that are being denied access to credit for which they may otherwise be qualified, or offered credit on less favorable terms, or steered into a narrower class of loan products, which, again, we don't want. There is a form of called reverse redlining, too, that can occur. But bias is the practice of an independent appraiser, so somebody that we would contract out for, not necessarily owned or an employee of the bank, and most likely not an employee of the bank, in order to place a value on the property owned by the minority person, for example, that is lower than the appraiser would place if the property were owned by a non-minority person. So, so the example is essentially if a minority individual versus a non-minority was denied credit as a result of the valuation that came in lower, and the reason why it came in lower was nothing more than the minority status. So the example does use race of the property owners, which is in fact a protected class, but it could also be, ethnicity of the owners or racial or ethnic makeup of the neighborhood itself. The issue is that the appraisal bias amounts to illegal discrimination within the appraisal process. And that invokes, obviously, two laws, the Equal Credit Opportunity Act and the Fair Housing Act. And, of course, we can't forget about UDAP, which is the broad brush regulation that they paint across just about every area within a financial institution, and to the extent that that is considered what we call unfair to consumers. So there's a lot to unpack, Len.
Yes, that's for sure. And my understanding is there's been some guidance issued recently regarding this matter. Can you elaborate on that?
Yeah, that's a great question. And I did briefly just kind of touch on it, that they released it in February, but the guidance reinforces anti-discrimination laws. So when examiners identify instances or practices of discrimination in the evaluation practices, These findings should be reflected in the ratings that are assigned to the institution pursuant to the FFIEC's consumer compliance rating system, which we're obviously very familiar with. As they rate institutions, they also offer credit for self-evaluation of certain things. So that's the rating that they're referring to in the guidance itself.
So is that information more for financial institutions or examiners?
Yeah, well, that's a great question, too. I think, in my opinion, it's probably both. Although the guidance is directed at financial institutions, it also acts as a reminder to regulators on the importance of the rating system. And from a safety and soundness perspective, should be reflected in an institution's ratings assigned under the Uniform Financial Institutions Rating System. So for institutions, the failure of internal controls to identify, monitor, and control valuation discrimination or bias could negatively affect the credit decisions, potentially exposing the institution to legal and compliance risks or affecting an institution's financial conditions and operations. Furthermore, material findings and concerns related to noncompliance with laws and regulations generally negatively affect the supervisory assessment of an institution's management in the safety and soundness examination. And they state it typically as a weakness within what we call that compliance management system or enterprise risk management overall. So very, very important stuff.
So this isn't a new issue, and it seems relatively straightforward. So why does it keep surfacing, Dean?
Yeah, well, you're full of the greatest questions today. I think that's what everybody's possibly thinking, but it's been an issue for many years. And I thought initially that the issues were more directed at appraisal independence, but the topic has evolved in importance to include the bias in the evaluation of the property itself, reevaluations when owners believe that bias occurred. How did the institutions treat that? Language within the appraisals themselves that arguably could suggest bias, such as desirable neighborhood, affordable, or gated community. While all of those things seem relatively straightforward, their implication could have a negative impact or therefore suggest some sort of discrimination in the appraisal itself.
So you're elaborating on a risk that bankers have to face, and certain our audience would like to get some guidance from you on how they can protect themselves against appraisal bias and potential liability under ECOA and the FHA.
Yeah, well, here are a couple of suggestions, and I probably have mentioned these before, either a year ago or 2 years ago, as part of our podcast series. But first, I would say have a detailed and thorough vendor due diligence process for the appraisal in appraisers. Vetting them is very, very important. Incorporate appraisal bias risks in mitigating controls into the fair lending risk assessment. Ensure that your financial institution review processes are designed to identify any hint of appraisal or evaluation bias. This would include sample appraisal reports for language or phrases that could prove problematic, as I indicated before: desirable neighborhood, affordable neighborhood, gated communities, et cetera, et cetera. Review for comments regarding the ethnicity of the neighborhood. Sometimes those are embedded deep within the appraisal, but those types of things could suggest, again, a bias. Incorporate statistical sampling of mortgage files, compare values to contract amounts, and then use HMDA data to identify target groups and control groups, purchases, refinance, etc., and compare whether there looks like there is any type of bias that occurred in the evaluation based on, ethnicity, race, or any of those prohibited basis. Ensure that anyone involved in lending or the appraisal process are appropriately trained on not only fair lending, but also what are the red flags under appraisal bias. Compare their automated evaluation services to the human performed valuation, because a lot of these institutions are using automated solutions now. So it's imperative that they look at that and have some sort of test relative to an actual appraisal and whether those are legitimate or look like there's any bias. Establish clear processes for reconsiderations. So when somebody asks for a reconsideration of the initial appraisal, that there's no bias that's found its way into that process, and that the a bank or financial institution is taking that reconsideration seriously and using an additional, what we call independent appraiser. And then last but not least, incorporate any appraisal complaint processes that are either received by your direct regulator or through the channels that the CFPB have set up for receiving complaints. So, those are just a few. I think it all really boils down to the control environment within the financial institution and taking these things very serious and having somebody qualified that can actually look at appraisals and look for those red flags that could suggest a bias.
Dean, as you were talking, I started counting your suggestions, and they added up to 9 great suggestions, which I'm certain our audience appreciates. And so we're about to wrap up today's discussion. Do you have any parting words for the audience today?
Well, I always like to add one little thing. I always say the little nugget at the end, but I would say that financial institutions should not downplay any evidence of appraisal bias. Make sure that your appraisers are properly vetted, controls are put in place on the ordering and review processes, and complaints are taken very serious in ongoing monitoring for compliance as evidence. So here we go again with controls over the process, and I think that should be sufficient.
Hey, that's 2 more great suggestions. We're up to 11 now. Dean, this has been a great topic, an informative one, and I'm certain our audience will find it helpful when they listen to this. This is Len Suzio with GeoData Vision.
And this is Dean Stockford from M&M Consulting saying thank you for listening to today's topic. Please let us know of any additional topics you'd like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and GeoData Vision on LinkedIn for all the latest news and information on compliance hot topics.